All right, ladies and gentlemen, I hope you had a wonderful day. The biggest trading week of this summer has officially began, and it was quite uneventful. We barely moved. The data wasn't that big. The Treasury refunding was below estimates, but all in all, there was not much action. But now tomorrow, we finally get some jobs data. You get bigger earnings with AMD and Microsoft after the bell, and then before you know it'll be one more day. Then we get Jerome Powell, the Fed, and then we close out the week with the jobs. So we got a lot of things to talk about. There is a lot on the table, even after hours too. You know, crowd, they just guided down because of all of the outages. But before we get into any of it, I thought I would give you the question of the day, which I kind of made this question up. Nobody really asked this, but we talked about other things, but I really thought we should talk about this to start off. How do you make the most money while trading earnings? And one, the answer is options. I have a little formula for you, but if you did not watch that video of the ghetto standard deviation and how to price options, I've been including it in the description of every single video this year. You better go and watch that. But one of the major tips in that video is to trade higher price names. So we have a big week ahead here with earnings. If you're looking for the right options to make a trade on, I would be looking for the stocks that are expensive. The more that the stock could move, if you get a cheap option and that thing goes in the money, when you start getting dollar for dollar, that is how you make a lot of dollars and a lot of percentage. So here is the simple formula. Options plus a high stock price equals bigger gains. Now, why I'm bringing this up, and now maybe this will make a little bit more sense. So I said I made up this question, but we talked about this topic a lot. If you've ever been there for any of the earnings previews, we bring this up a lot, and it has to do with the share price of the stock. Not only do I want you to trade the more higher price names, but when it comes down to earnings, I would also avoid the lower share price names, especially when it comes to buying a put contract. Why? When you buy a put option, the amount of gains are limited, and the max gain you could get on a put is if the stock goes to zero. So if the stock is a $2 stock, a $1 stock like Tilray, which reported after hours today, or think of any of the cheaper names, if you buy a put and that stock goes to zero and it's a $1, $2 put, the max gain on that contract is going to be $200. Unless you're getting it dirt cheap, it's going to be hard to make a big gain compared to a stock that's in the 200s. Again, go look at what happened with CrowdStrike. I'm sure even you could compare this to some of the options that'll come out tomorrow, but a higher price stock and then cheaper options, you could capture that $10, $20, $30. That's how an option can go from 20 cents into $20, literally $30 into 2,000. So I hope this helps. I think it is a solid tip that'll take you into earnings. Make sure you watch the video as well. But now, Chad, we still got a lot to go over. I have the plays, all that good stuff. What I need from you, a thumbs up on the video. Make sure you're subscribed. And if you don't know, we are live Monday through Friday, 30 minutes before open, youtube.com/the stock market. We will see you there in the morning, baby. Run it.
Working to the couch, it's the 2020 election. Live in the hills, but I still get a spread. Started with a live, but I still reinvest it. Feel how I feel, then you feel like a blessing. I just want the lesson, I just want protection. I'm up and I'm down, but they sound like progression. Farmer never plans if he waits for perfection. Finger to the down.
All right, off the bat, I hope you all take those options tips to heart. And remember, if you are going to be playing any of those earnings, we will be there doing those previews every day, especially this week. But to start off the keys, it was definitely a boring day in the market, but the hype was real. Wall Street agrees that this is going to be one of the biggest weeks. I was saying this last night before any of the articles came out in the AM, and I woke up this morning, everywhere was agreeing that this was about to be the biggest week. Even if you go and look at the volatility, we will go look at what's priced in, because that was very accurate last week. All of the volatility is pointing to a bigger move this week. It has to do with all of the events. Not only do you have about 30% of the S&P 500 Fed reporting. You have Jerome Powell on Wednesday, the jobs report on Friday. You also have the Bank of Japan, and then this is going to give us everything from earnings down to the schedule of rate hikes. So we still have a lot we're going to deal with, a lot we're going to talk about. The movement wasn't big, and we're holding this range that we were in last week, but the hype and volatility is very, very real. Now, here is the problem. A lot of people are expecting this to be a big week, and now you got to really think about it. If everybody is getting excited for all of these events, it is more likely, the more everybody prices this event in, the higher the pricing in goes on the week, the easier it's going to be to disappoint. Pretty much with everybody expecting a lot of things to happen, if that ramps up over the next 2 days, the bar will be set very high. It may be easier that we get a disappointment that no matter what happens, we make a bigger pre-move, because we've moved 10% in the last 2 weeks rather than actually moving once we get through all of the events. So this is the thing that I'm keeping in mind. I think it's going to be very interesting depending on how we move, but pretty much prior to Powell, and then obviously the jobs report on Friday. That's probably going to either add to or erase anything that happens before that. And I'll even say I do think the jobs report on Friday will be the number one event. So even then, with that being said, going into the next key, tomorrow you will be getting the JOLTS jobs report. You're not getting the non-farms. That one's going to be on Friday, but tomorrow will be the job openings, and it's really been hit or miss. Sometimes the job openings has been able to move us. Sometimes it hasn't. It really all depends on the level it comes in at. It's not that we don't know if job openings are important or not. A lot of people do debate the correlation. It's not as if job openings really show you what happens on the non-farms, but the simple part that we've seen a lot here is that if there is a gigantic miss, if it comes in way above or way below, again, numbers like I think 7 million in job openings, a 6 million would be crazy, and then vice versa, higher or lower. If there is a bigger surprise on the openings, that is more likely to move things. So that'll be our first set, though, of any of the big jobs data this week. That's going to be coming out, I think, hour before or hour after the bell, and then we're also going to be getting the Conference Board of Consumer Confidence. That will be another thing, but when it comes down to the jobs report, either tomorrow, whether we get a surprise or not, or even Friday, I'm telling you, I think that jobs report on Friday is going to be the most important thing this week. What you need to be looking for is any signs of cracking. People want to see big moves in the jobs market because that's going to let you know whether or not Powell and the Fed should be going earlier or later. That'll help confirm the soft landing, no landing, whatever it may be. So that's why I'm saying here, if we don't get any signs of cracking, we go right back to riding the golden path, and you're just playing the same narrative that got us here. If the job market starts changing, then people are going to start clamoring for more immediate shifts as we start to see that, both recession and rate cuts. So it'll get very interesting, but that's what we have on the schedule for tomorrow. You could keep some of the broader stuff in mind for the end of the week. And then finally, if I could throw this out here, because we're going to have to deal with a couple of things, I think today was a reminder of how slow things can be when we aren't absolutely selling off. The Russell did not do good today, and a lot of people were saying, wait, why is the Russell selling off? I wouldn't make a big deal about it. Literally, the NASDAQ and SPY have both been murdered over the last 2 weeks, and the Russell is still up over 10%. This is kind of just chilling out, especially with all of the earnings and events that we're getting into. I think today just wasn't death and destruction, and even in that, the fact that we didn't have a lot of volatility, you probably noticed the volume was very, very low. So don't forget, it's still summer, and I think a lot of those effects still apply. We just saw that quick pickup as we started to sell off, and that's what I'm saying here. We'll see what happens after the data, but even then, even tomorrow, if the data in the morning or any of the earnings doesn't really get things excited, we may just be range bound, and maybe we deal with a lower volume, chiller day, as long as we are not selling off and everybody's worried that the market is going to crash, the VIX, the dollar, and then all of that good stuff. So hopefully you're ready for all of it, but either way, welcome to one of the biggest weeks, and then on Friday we'll see if all of the hype was warranted or not. But now let us get into the plays. So right off the bat, I have 3 different plays. I actually really like this one. This is the first one, and I grabbed it here in the morning, so I'm going to be watching this all week. I did a decent play. Which one was the ones that I grabbed? I grabbed Disney September 20th, so I got a little bit more time, and I went for the 110 calls for 43 cents. I bought 10 of them for about $400. This one is a little further than 2 standard deviations. That is related to that tutorial that I was telling you about with pricing. So this one's a little bit out of the range, but with a little bit more time. But why I went for Disney, I think now is a decent time to watch the pre-earnings. I got it in the morning before the stock went up 2%. So if you were there in the morning, that was awesome. And it worked out. The plays went up about 20% so far. So that's what I'd be careful on. But the idea that I'm going with is get the pre-earnings play. They have earnings next week. So if any of the earnings this week do good, maybe they'll be able to ride some of the juice. But in general, I think the movie data in Disney, I don't think they have done as bad as the stock has done this quarter. So they've had good movie releases. We'll see what happens with their growth in Disney Plus and the parks and how they spend. But think about it. We've had holidays, and I think it's a good cycle here for some of the guidance for them. I don't think their company has been as bad as some of the price movements have been, and I think a lot of the selling was due to that proxy situation. Nelson Peltz, who was it, the Marvel guy who just sold out, I think that's been contributing a lot to the downside. The stock, literally, we were up like 30% on the long term, came right back down to break even. That's around these prices or a little bit where it was like yesterday or today and on Friday. So I thought it'd be good for pre-earnings. Got a little bit of time. If ideally these go up and we can make them free, that's what I'm going to do. But I think early play on this one, because there is a week of time, I think it might be worth it, and then we'll find out. Does going early pay us out, or does it kill us? Find out on the next episode. But that is play number 1. Watch out for that. Then play number 2 is Humana and XLV, and I really like this one. Not only has Humana ran up a lot, remember that last earnings, I think I played it around like 320, and that went crazy. I've even brought up Humana as a potential long-term play, but Humana, XLV, I would watch out for all of these. Humana has earnings on Wednesday, but either before or after that, I think healthcare is going to be very important, and depending on how some of the other stuff reports, it could kick a lot of this into gear, or if they set off a bad trend, that'll be something too. But healthcare is even tied to the Trump trade and this broader rotation with some of the stuff we've seen with the Russell. I think these are going to be important to watch. So especially if there's a blowout earnings, I think Humana, Cigna even, I think that's end of the week or on Thursday, even Pfizer tomorrow morning, all of these will be important to watch. And just in general, watch out for XLV in the broader scope of some of the other themes that we have seen. But that is play number 2. And then finally, play number 3, baby. Baba K-Web Baidu. And why I'm bringing this one up, because there's a lot of talk about Japan and the Bank of Japan that we have this week. There's a lot of talk about what's going on with earnings in the United States and Jerome Powell. And honestly, I'd say just keep an eye on China. Baba came out with something today about like raising prices and people like that, but China's bond yields have hit an all-time low. I posted that one on my Instagram if you saw it, and they've just surprised with the rate cuts. So with everybody having their eyes on all these other factors, if there is big changes with China, or excuse me, with Japan, and then with the United States, I would keep an eye on what happens here with China. Again, it's not too long ago, even their currency wasn't doing that hot as well. So we'll see how that all plays out. But those are the main plays. As far as what I did today, that's why I only have the question here. I didn't do much. All I did was that Disney play, the September 110 calls at 43 cents. Spent about $400. Like I said, if we can make them free, that's what we'll do. And then still holding that gold. I think it's going to close out tomorrow automatically on the rollover. And then I still have that MES. Every time it goes green, it just sells off. So still riding that one out. But besides that, I have a lesson for you. And today we're going to keep going on the MNCs. There's a lot, and it's a lot of info, but hopefully you've realized it by now. And even then, I'm going to continue like mid-paragraph. We are right in the middle of discussing how difficult it is to regulate multinational corporations and how difficult it is to figure out the relationships and codes of conduct between the countries and the companies. And it was explaining some of the history, how, the problems back and forth, from the 50s, 60s, even the 70s, 80s, and 90s, we still haven't really locked down these agreements. And that's why how some of this stuff works. That's why I was even telling you, we're all in the early days of it. So still got a little bit more of that lesson. And then after this, it's almost done after today. I think we're going to get into the conclusion. And then before you know it, we're going to be on chapter 10 probably by the end of the week. So hopefully you're locked in. Again, this book is International Political Economy by Thomas Oatley. If you go to this channel too, we have the playlist of all of these lessons. If you want to participate, I think that's the terminology. I think so. We'll see. But getting into the lesson now, I think we left off where it was like going over that quote, and remember the MAIs, they couldn't agree on them after spending all of that time, and they were saying like all the exemptions is pretty much led over time to everything kind of getting diluted. So continuing from there, in all, some 600 organizations in almost 70 countries spoke out against the proposed treaties. The combination of conflict among the OECD governments about the specific content of the treaty and public opposition proved fatal. Negotiations ceased in December 1998 without a final agreement. In the absence of a broader multilateral framework, states have come to rely heavily on BITs. A BIT is a legally binding agreement between two states that establishes the terms that govern private investment by residents of one state in the national jurisdiction of the other. The typical BIT requires fair and equal treatment, limit expropriation, and protects the repatriation of earnings and assets. In addition, a large number of BITs include arbitration clauses that commit the parties to adjudicate disputes in international forums such as the International Center for the Settlement of Investment Disputes, ICSID. Though BITs have been a part of the global economy since 1959, they emerged as the predominant approach to governing FDI beginning in the late 1980s. In the early 1980s, states had signed fewer than 500 BITs. UNCTAD estimates that in the mid-2017s, there were 2,360 BITs in force, as well as the 307 bilateral and plurilateral treaties, such as regional trade agreements, that contain investment provisions quite similar and in some instances identical to those found in the typical BIT. In the absence of a single multilateral regime, therefore, states have created a very decentralized system by negotiating separate agreements within their investment partners. So hopefully you're understanding it. This problem is very difficult. And remember, I kept bringing up the WTO and some of that stuff, and you see it, but we don't have a body for trade. It's easier to govern trade and products and services than it is the investments and the rights of, again, a foreigner investing in somewhere else and doing that. So what ended up happening, it has devolved or evolved into a decentralized system of just agreements. One party agrees with each other, these BITs. So they were just pretty much making agreements. So like, think about it. If you can't make a deal with everybody, you're like, well, we trade with Mexico a lot, so let's just make an agreement with how investments and private investments, a bilateral agreement with Mexico. Okay, we're going to trade with Canada a lot, we'll just do it with them. And that's what it's saying. After the late 1980s, since nobody could figure out this like international mechanism system to regulate FDI, it evolved into a system of everybody just making, hundreds if not thousands of agreements with each other to figure out a system where everybody felt safe enough to transact, do business, invest, and then leave us with the system we have today. So continuing, this system is also highly asymmetric to the typical BIT, offers strong protection to MNCs while doing little to expand the rights of host countries. The standard BIT includes a commitment to remain open to FDI from the partner and to adhere to the principles of the national treatment and MFN. In addition, BITs typically restrict the right of states to expropriate foreign investments to a legitimate public purpose and relies upon the historical standard of prompt, effective, and adequate compensation when expropriation does occur. In addition, BITs contain dispute resolution obligations, and many of the treaties obligate the parties to accept the binding third-party arbitration within the ICSID or the United Nations Commission on International Trade Law. Indeed, a typical BIT thus reveals the asymmetry inherent in the current FDI regime, as the terms reflect the legal conceptions of capital exporting states as they have developed during the last 100 years and make little to no effort to protect a conception of host country interests. The asymmetry is evident also in the distinctive natures of BIT dispute settlement provisions. In practically all other international treaties, states and only states have standing in dispute resolution proceedings. Under the WTO dispute settlement mechanism, for instance, states initiate disputes against other states. States might pursue trade disputes in response to pressure from firms, but it is the state, not the firm, that has the legal right to file a claim and be heard. Moreover, in the WTO, states are punished for violations. Brazil could remove concessions on American imports until the U.S. government comes in compliance with WTO rules on agriculture. In BITs, private firms have standing. A firm based in one country has the right to sue the state of a foreign country in which it had an investment. Moreover, the firm has the right for the suit to be heard by a third-party arbiter rather than being required to work through the host country court system. Finally, when firms are successful in their suits under BITs, they are awarded monetary compensation. BITs thus create a fairly onerous set of obligations for host states and create an intrusive dispute resolution system that kicks in when violations of the treaty obligations occur. These characteristics have led many to consider the BIT regime asymmetric. So if you're not understanding too, what does that asymmetric means? It's saying, well, it's very beneficial only to the MNCs. If you're not getting that last part, it's kind of wild, and this is a huge distinction, and this is what the BIT is allowed, and this is why the next question is going to be, well, wait, hold on, if this is so one-sided on who benefits, or it seems like it benefits the corporations more than it would benefit the host country and kind of leaves them out, why do these host countries end up doing it? That's what we're going to answer next, but hopefully you're seeing what it's describing here, and like WTO and the trade mechanism, it's state versus state. It's country against country. That's how they're resolving and disputing everything. With the BIT, if any of these, it could be a corporation versus a country and a country versus a corporation rather than state versus state or country versus country. So continuing, why do host countries enter BITs if they're so asymmetric? The standard explanation focuses on the inability of a sovereign state to pre-commit itself to investor-friendly policies. The core logic of this argument harkens back to the obsolescing bargain model. States can have an incentive to renege on the initial agreement once an investment has been made. Moreover, because developing countries are typically hosts to foreign investments and much less frequently the home of MNC parent firms, developing countries may be less concerned about reciprocity of treatment than they are about the trade. In the absence of mechanisms to prevent or at least limit ex post opportunism, states will attract less foreign investment than they desire. The challenge of attracting investment without signing BITs is magnified in a world which all of the states in which you are competing with to attract for do sign BITs. Within this strange context, BITs can provide a mechanism that helps states commit to investor-friendly policies. BITs provide a stable policy environment by locking states into a set of enforceable international obligations. They lock countries into agreements that offer national and non-discriminatory treatment to foreign investors, allow foreign firms to access dispute settlement procedures, and promise third-party arbitration of disputes, and violating these provisions does not seem to be costly, and hence there is evidence of credible commitments. Thus, the states sign BITs because they believe that on balance, the benefits they realize from doing so, benefits that arise from increased FDI inflow, outweighs the cost associated with accepting restraints on their policy choices in the future. So hopefully you're getting it. It's one thing, I mean, you could even debate on how costly it really is if you don't follow through, but in general, it's saying a lot of these developing countries as well, they don't really have plans for investor policy, so to sign on to these agreements that opens up the door for them, and they weren't even planning on regulating certain things, and they are more concerned with other stuff at one level, and then again, they could always change it. Don't forget the obsolescing bargaining power shifts depending on how investments are made over time. It makes sense for them to tag along, even though they may not be getting as many benefits, but they may not value those benefits as much as, let's say, a developing country would. But continuing, it's growing less clear that the benefits that BITs provide do in fact outweigh the cost of the carry. On the one hand, it has proven remarkably difficult to find robust evidence to support the proposition that states that sign BITs attract substantially more FDI than states that do not. On the other hand, the frequency of disputes and thus the cost of litigation for developing countries has risen dramatically. In 2016 alone, the ICSID heard 74 new disputes from firms with the developed world responsible for 62 of these claims. During the last 6 years, the ICSID has seen 64 new disputes each year on average, up sharply between 25 and 40 new disputes per year during the first decade of the 20th century, and fewer than 10 new disputes per year during the 1990s. Since 1990, more than 90 states have been sued under BITs and other IIAs, and more than half of all cases involving a firm from the developed world are suing a developing country. And of the 471 ICSID concluded disputes for which have the information, firms win about 27% of the time, while states prevail about 36% of the time. The remaining suits are either dismissed, discontinued, settled, or resolved without either party winning. When firms do prevail, the median monetary compensation region is about $20 million. Developing countries and a few advanced industrialized countries are beginning to push back against BIT regimes. Bolivia, Ecuador, and Venezuela have opted out of the BIT resolution. In 2016, the Indian government drew from 57 BITs that it had ratified and was making plans to negotiate new agreements based on its own template, one more favorable to host country interest. On other states, Indonesia, as one prominent example, are renegotiating their BITs as they expire. The UNCTAD reports that more than 350 BITs will be up for renewal between 2014 and 2018, and it will be interesting to observe how much of those treaties are restructured in light of the experience with binding arbitration. It does not seem that the pendulum is likely to begin to shift back towards the interest of capital importing countries. Although governments have spent almost 30 years negotiating rules to regulate FDI within the UN, within the GATT, and within the OECD, they have yet to agree on a regulatory framework. Conflict between capital exporting countries and capital importing countries over the basic purpose of such a regime is the primary reason for this lack of success. Governments have been able to agree with such rules how they should regulate host countries or MNCs. The obvious compromise that international rules might usefully regulate both has yet to materialize in a meaningful way. So we are going to get to the conclusion, but this is pretty much it, and I hope you guys get it because this is even just showing you there's no progress on any of this to this day. I mean, yeah, they're doing all these treaties, but we left off at BITs. That's where we are today. This last paragraph really sums up everything. We don't have a regulatory framework. There's conflict between export of capital and capital importing and people trying to figure out the reason. Governments have not been able to agree on rules. It would be nice if we could internationally regulate everything, but you haven't really seen a system materialize in an effective way. So that's where we're at now. We're going to wrap up this chapter with MNCs. Like I said, though, this will come up at another point because there is more than this role that these guys play. So we'll see where it takes us. But yeah, that is your watch list, ladies and gentlemen. Make sure hydrate healthy, ready to go. Make sure to post your watch list. Make sure we see you there in the morning. I need the armor on. I need the helmet shining. And I need you to remember, control the expectations. You expect a lot easier to get let down. I don't know what you expected, but you got to expect you reap what you sow, baby. So put in that work, Chatadonia. I'll see you in the morning. I'll see you in the AM. Have a good night rest and horn.